Hello and welcome to the State of the Fleet Industry, a weekly video series produced by Automotive Fleet magazine. I'm Mike Antich, editor of Automotive Fleet, and today I'd like to examine what's occurring in the fleet industry for the week of July 11th, 2022. And for this week's episode, I'd like to explore today's higher fuel prices. And admittedly, this is a tricky subject to discuss because there are so many variables ranging from the volatility of commodity prices to larger geopolitical events, all of which individually or in unison can influence the price of fuel. And these variables are unpredictable, which makes it all the more difficult to forecast fuel prices. So when I ask fleet management companies what source they use to assess future pricing trends for fuel, almost every one of them says they use the U.S. Energy Information Administration, which is the statistical and analytical agency for the U.S. Department of Energy. And the U.S. Energy Information Administration, or EIA as it's called, tracks trends in the petroleum market on a week-by-week basis. And when I read the July 7th EIA report, which was just published Thursday of last week, it reported that U.S. gasoline consumption for the second quarter of the year, 2022, was actually lower than same time last year, the second quarter of 2021. And the question is, why did this occur? One reason cited by the EIA is that fuel prices were up 61% in June of 2022 compared to the same time last year. And this spike in higher fuel prices reduced the total vehicle miles traveled in May and June of this year. So fewer miles driven resulted in fewer gallons of fuel burned, hence the decline in total fuel consumption in the second quarter of 2022. This phenomenon is called demand destruction, which occurs when there's a period of high prices, such as today's higher fuel prices, that causes consumers to change their behavior, namely causing them to drive less, hence reducing overall fuel consumption. But as the EIA says, the reduction in total fuel consumption has a nominal impact on gasoline prices, generally only reducing the per gallon pump price of gasoline by about 2 to 4%. And we're seeing fuel prices start to inch downward, not by much, but they are moving downward nonetheless. So to put this in context, on July 5th, the average national price for a gallon of unleaded gasoline was $4.80. And this was down from $4.88 the week prior. So an average 8 cents per gallon decrease. So this average 8 cents per gallon decrease illustrates the nominal impact that the reduction in fuel consumption has on a per gallon price of gasoline. It does have an impact, but it's nominal. So in addition to the EIA forecast, I personally use another source when attempting to assess the future direction of fuel prices. And this other source is the futures market for fuel. And you might ask, what is a futures market? The fuel futures market is where a financial contract is used to buy or sell fuel at a predetermined price for delivery sometime in the future. But the futures market goes beyond just fuel. There's a futures market for almost every type of product, including commodities such as metals, oil, currencies, grains, and animal products, such as the proverbial pork bellies that people joke about. But pork bellies are actually traded in the futures market. One of the products traded in the futures market is gasoline futures. This involves buying gasoline in the future at a price that either a buyer or seller thinks the fuel will be selling for at a future date. And this is a good barometer because it tells you what the market thinks will be the future price of gasoline. Of course, they can be wrong, but nonetheless, this is what the market believes will be the future price of fuel or any commodity that's traded in the futures market. And there are people and institutions willing to put money behind this forecast. So last Tuesday, July 5th, the U.S. gasoline futures market was down 9.7%, which was the biggest drop in the past 16 weeks. In other words, the gasoline futures market believes that gasoline will be cheaper in the future than it is today. And according to the fuel website, GasBuddy, if the decline in gasoline futures is sustained, and that's important, it's got to be sustained, then the retail price of gasoline could fall as much as 65 cents per gallon. And the question is why? Why are these traders buying and selling gasoline in the future at a lower price than today? And the reason given by financial analysts is that these traders anticipate that a recession will occur sometime in 2023, putting downward pressure on gasoline prices. And this anticipation is also shared by a number of major financial institutions that are likewise warning publicly of their concern of an impending recession. So, for instance, Deutsche Bank, this was the first bank that to cite this warning, and they expect a recession in mid-2023. Wells Fargo likewise predicts a recession in mid-2023. Nomura Holdings, a multinational financial organization headquartered in Japan, believes a recession will occur even sooner. They see it starting at the end of calendar year 2022. And Citigroup says that there's a 50% chance of a recession occurring. And as I said many times in the past, time will tell whether these concerns are real, but nonetheless, this is the current thinking of major financial institutions as to the future direction of the price of fuel. And for my closing observation, I would like to touch upon the impact of today's higher fuel prices on the types of vehicles end users are acquiring. So historically, when there has been a spike in fuel prices, especially when the prices exceed a certain psychological buying threshold, past experience has shown that there'll be a change in vehicle acquisition pattern by consumers. So for instance, when the price of gasoline first exceeded the psychological threshold of $3 per gallon in 2008, and likewise when the price of gasoline exceeded for the first time $4 per gallon in 2012, there was a sharp decline in the sale of SUVs and a corresponding uptick in the sale of smaller subcompacts and compact passenger cars. But when the price of gasoline exceeded the next psychological threshold of $5 per gallon in 2022, the demand for SUVs and full-size pickups continued to be strong and remained strong, and the buying patterns did not change, contrary to what has occurred in the past. And the number one reason there wasn't a change in vehicle acquisition patterns was because of the significant improvement in fuel economy for pickups and SUVs. So for instance, a full-size pickup in 2022 now has an EPA-rated fuel economy of 21 mpg combined, which is a 50% improvement over a comparable 2008 model. Plus, there are fewer alternative sedans in the market today, as most OEMs have transitioned their product portfolios to be primarily comprised of crossovers and utility vehicles. So the end result is that with the proliferation of turbocharged four-cylinder engines in many of the larger vehicles today, higher gasoline prices are now less of a factor in the type of vehicles that consumers will acquire. And in the future, it'll be interesting to see when the next psychological threshold in fuel pricing occurs, whether there'll be a cannibalization of ICE product sales to EVs. So with this as my final observation, I'd like to conclude my State of the Fleet Industry presentation for the week of July 11, 2022, and I'd like to thank you for watching.